Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
Today, we're tackling a paper that's really essential if you're involved in debt contracts, credit risk, or even advanced financial accounting. Seriously foundational stuff.
We're looking at Christensen and NIKOLAEV's 2012 paper, Capital versus Performance Covenants in Debt Contracts. And it's not just about listing out restrictions in a loan agreement.
No, it goes deeper.
Much deeper. It's about proving that different types of accounting numbers play fundamentally different roles in managing those tricky agency costs between lenders and borrowers.
Okay, let's get straight to it then. Frame the paper for us. What was the big question they were trying to answer about how these debt deals are structured?
Well, the main goal was really to move past thinking of a covenant as just one thing. They asked, what actually drives the specific mix of covenants in these packages?
So not just if there are covenants, but which ones?
Exactly. Do covenants based on, say, balance sheet numbers versus income statement numbers work differently? Do they reduce agency costs through distinct economic mechanisms?
And how does the firm's own accounting information play into that choice?
That's the crucial third piece. How does the sort of usability, the contractibility of a firm's accounting data influence whether lenders and borrowers lean towards one type of covenant or another?
And their approach involved digging into real-world data, right?
Oh, yeah. They use private lending data from DealScan. But the challenge is measuring these concepts that aren't just sitting there in the data, like how financially constrained a firm is or how good its accounting is for contracting.
How did they tackle that?
For financial constraint, they use well-established indices, Whited and Wu, Kaplan and Zingales, Cleary, pretty standard, robust stuff.
But the accounting part sounds trickier.
It was. Measuring accounting contractibility was a key methodological step, and we'll definitely unpack that more. But using these measures, they landed on a really clear main finding that these accounting-based covenants really do improve efficiency in two fundamentally different ways. They confirmed two distinct contracting mechanisms are at play.
Two mechanisms link to two types of covenants. Give us the quick definitions.
Okay, so first you have key covenants, performance covenants. Think income statement, cash flow data, interest coverage, debt to EBITDA, things like that.
And these are used when?
They tend to be associated with borrowers who are more financially constrained, but critically, only when their accounting information is, let's say, highly reliable or contractible.
Got it. And the other type?
C covenants, capital covenants. These are purely balance sheet based. Your leverage ratio, debt to net worth, much more static measures.
And the trade-off looks like?
Well, the big picture is firms that are constrained and need operating flexibility tend towards P covenants. But firms where maybe the accounting signals aren't as clear or where the lender really wants strong upfront alignment, they lean towards C covenants.
Interesting. So it's a strategic choice based on the firm's situation.
Precisely. They found, for example, construction firms' long product cycles, maybe less predictable short-term performance, often use C covenants heavily. Whereas airlines, often constrained but needing flexibility, used P covenants more. It's a fundamental design choice.
That distinction is clearly vital. Let's pause and make sure we've really nailed down these key terms because everything else hinges on them. C covenants first. What's their underlying mechanism?
Okay, C covenants, using things like debt to tangible net worth. Their job is really about ex-ante interest alignment before anything happens.
How do they align interests?
By forcing shareholders to keep enough skin in the game. They restrict the capital structure, making sure there's enough equity cushion. This increases the shareholders' own downside risk if things go bad.
Which discourages them from taking wild risks later on.
Exactly. It helps mitigate those classic agency problems like asset substitution, swapping safe assets for risky ones, or debt overhang, where shareholders won't fund good projects because the benefits mostly go to debt holders. C covenants try to prevent that up front.
Okay, clear. Now, P covenants, performance covenants. Relying on things like debt to EBITDA, what's their function? It sounds more dynamic.
Very different mechanism. P covenants are about ex post contingent allocation of control. Think of them as a timely tripwire.
A tripwire, meaning?
Meaning if the company's current performance, measured by that P covenant metric, drops below a pre-agreed level, bang. Control rights automatically shift, at least partially, to the lender.
So the lender can step in quickly or performance dips.
Right. It allows them to intervene and prevent managers from taking actions that might destroy value when the firm is already struggling. It's a mechanism for timely intervention based on current results.
And the effectiveness of that tripwire depends on this idea of contractibility of accounting information. Let's define that properly. It's not just about good quality accounting.
No, it's more specific than just general quality, although quality is definitely part of it. Contractibility in this context refers to the statistical power of the firm's accounting numbers, like ROA or interest coverage, to actually explain and predict credit risk.
So can these specific numbers reliably tell us if the company's risk profile is changing?
Precisely. Can we trust these numbers to signal a potential default or downgrade? They measured this empirically.
How?
Yeah.
That sounds difficult to quantify.
They used a clever approach with ordered logic regressions. They basically tested how well a firm's accounting ratios could predict its actual credit rating category. The statistical measure they got from that a pseudo R-squared value became their proxy for contractibility.
Ah, okay. So a high pseudo R-squared means the accounting numbers are good predictors, high contractibility.
Exactly. And if contractibility is high, you can trust that P-covenant tripwire. It's likely to trigger when there's a real problem.
But if contractibility is low,
then that tripwire is unreliable. It might go off based on accounting noise, triggering a costly renegotiation or control transfer unnecessarily, or it might fail to go off when there is a real problem. That's why low contractibility pushes parties away from P covenants.
that makes a lot of sense. It provides the framework we need. Okay, let's tackle the first of our structured questions. Q1. What is the specific research question, and why is it important?
Well, the paper explicitly asks, what determines the design of these covenant packages? Do covenants based on different accounting ratios really reduce agency costs through different mechanisms? And how do accounting properties, specifically this contractibility idea, influence that choice?
And the importance. You mentioned earlier work-treated covenants more generically.
Exactly. Think back to Jensen and Meckling or Smith and Warner, foundational work, but they tended to view covenants as just, well, restrictions. This paper refines that significantly.
No, so.
Its importance really comes from providing strong empirical evidence for theories developed much earlier in contract theory specifically. Aghion and Bolton's 1992 work on financial contracting under incomplete contracts and agency issues.
So Christensen and Nikolaev basically showed that what Aghion and Bolton theorized actually happens in practice in debt markets.
Precisely. They connected the theory to the specific accounting ratios used in real-world contracts.
Which brings us neatly to Q2. What theories do the authors rely upon to develop their hypotheses? You've mentioned Aghion and Bolton.
Yes, their 1992 paper is the bedrock. It posits that financial contracts in a world with agency conflicts and where you can't write a contract for every possible future state need mechanisms to handle control and incentives.
This paper links those theoretical mechanisms to the covenant types.
Directly. Aghion and Bolton's mechanism 1 is about aligning interests ex ante. Christensen and Nikolaev argue that's exactly what C covenants do, requiring equity, making shareholders share the downside, reducing moral hazard up front.
And mechanism 2.
A and B's mechanism 2 is about efficiently reallocating decision rights ex post, usually when bad news arrives. That's the P covenant function, the timely tripwire that transfers control to the lender when performance falters, allowing intervention precisely when the lender's claim is most at risk.
Okay, connecting theory to practice. Let's shift focus slightly back to the managerial side, which we touched on earlier. For the CFOs, the treasurers listening, what's the concrete trade-off they're making when negotiating these covenants?
It boils down to a fundamental trade-off between financial flexibility and, let's call it, renegotiation risk, or the cost of guaranteed alignment.
Unpack that a bit.
Okay, if you as a manager agree to tight C covenants, you're essentially locking down your capital structure. You might find it harder to raise new debt or equity later, even for good projects. That's low flexibility.
But the upside for the lender is?
The lender gets that ex-ante assurance, that skin in the game. It provides stability, reduces their monitoring burden perhaps, high security for the lender, low flexibility for the borrower.
And the alternative? Leaning towards P covenants.
If you go with P covenants, especially if you're a growing firm that needs to adapt, you gain flexibility in your capital structure. You're not tied down by rigid balance sheet ratios.
But there's a catch, right?
The catch is the tripwire. You're exposed to potentially frequent renegotiations or interventions if your performance metrics dip, even temporarily. That means potential disruptions, renegotiation costs, maybe loss of control.
And that path flexibility via P covenants is only really viable if?
If the accounting information has high contractibility, if that performance signal is reliable. Otherwise, the cost of false alarms or missed signals from the P covenant is just too high.
So low contractibility really forces your hand towards the less flexible C covenants.
It seems so. If the numbers are noisy, the simple, perhaps blunt instrument of requiring capital upfront, C covenants, becomes the more efficient or at least less risky choice compared to a faulty performance-based tripwire, P covenants.
Okay, that's crystal clear. Let's move to Q3. How does the research design address validity construct, internal statistical conclusion, external, and also things like non-random assignment? These are complex contracts.
They were very conscious of validity. For construct validity, are they measuring what they think they're measuring? They made a key choice instead of just counting covenants.
Which might be misleading.
Right. They used the ratio of P covenants to total covenants, PP plus C, as their main dependent variable. This directly captures the mix or the trade-off between the two types, not just the sheer number of restrictions.
Smart. And for measuring constraint and contractibility.
Using multiple established indices for constraint, WWKZ-CL, helps ensure the finding isn't dependent on one specific measure. And the careful derivation of the contractibility proxies we discussed also strengthens construct validity.
What about internal validity, making sure the relationships they find aren't due to something else?
That's where the control variables come in. They included a host of firm and deal characteristics: size, book-to-market, deal size, maturity, whether it's secured debt, a revolver loan, industry fixed effects.
Trying to isolate the effect of constraint and contractibility.
Exactly. By controlling for things like growth opportunities, proxied by BM, or asset tangibility, related to secured status, they reduce the risk of confounding factors driving the results.
And issues like non-random assignment or just changes over time.
They included year fixed effects in their models. That's crucial for soaking up any economy-wide trends, regulatory shifts, or even changes in accounting standards over their sample period. Think about shifts towards fair value, for instance. Year dummies help control for that background noise.
They also did robustness checks, I assume.
Yes, including things like using factor analysis to build the constraint and contractibility measures, confirming the results weren't just an artifact of simple counts or specific index choices.
Okay, that leads into Q4. What specific econometric methods did they employ, and how did those choices help address any design weaknesses? You mentioned nonlinear models earlier.
Right. The nature of their data dictated the methods. Much of it isn't continuous. For deriving the contractibility proxies, remember, they're predicting credit ratings.
Which are ordered categories, not numbers on a line.
Precisely. AAA, AA, etc. There is an order, but the distance between AAA and AA isn't necessarily the same as between B and C. So they correctly used ordered logic regression, which is designed for that kind of ordinal dependent variable.
That respects the data structure. What about other dependent variables, like the PP plus C mix, or whether a renegotiation happened?
For the PP plus C mix, while their main tests used OLS with the ratio, in robustness checks analyzing the choice between covenant types, they again used ordered logic or multinomial logic, suitable for categorical choices.
And for things like predicting if an amendment occurs, that's a yes-no outcome.
Right, a binary outcome.
Yeah.
So they used standard logic regression for that, hypothesis H3. And when they looked at counts like the number of amendments or the number of negative covenants, hypothesis H4, they used Poisson regression.
Which is the standard model for count data.
Exactly. So the choice of econometric tools was really tailored to the specific type of data for each hypothesis, which strengthens the statistical conclusion validity.
Did they do anything else to bolster confidence, maybe using alternative data?
They did. One nice robustness check involved using credit default swap, CDS, spreads instead of credit ratings to calculate contractibility. CDS spreads are market-based and more timely, arguably.
Did it change the results?
The sample size dropped quite a bit because not all firms with deal scan loans have traded CDS. But importantly, the main findings held, suggesting the results weren't just driven by potential staleness or biases in credit ratings. That adds rigor.
Okay, the design method seems solid. Let's get to the payoff. Q5. What were the major results, and did they actually answer the research questions? Summarize those 4 key hypotheses.
Absolutely. They found strong support for all 4. First, H1 on financial constraint, confirmed. Financially constrained firms measured by those indices definitely rely more heavily on P covenants. The coefficients were positive and significant.
So constraint pushes firms towards that flexibility tripwire mechanism.
Yes, it suggests the need to avoid rigid capital structure restrictions often outweighs the risk of control transfers for these firms.
Second, H2 on contractibility, the crucial link.
Also confirmed, the reliance on P covenants, that PP plus C ratio, was positively and significantly associated with their measures of accounting contractibility. Higher contractibility, more P covenants used.
So P covenants are only viable when the accounting numbers are trustworthy signals.
That's the clear message. It directly supports the theory about the tripwire needing to be reliable.
Third, H3 on renegotiation. Does the tripwire actually lead to action?
Confirmed again. The presence of P covenants was a significant positive predictor of subsequent contract amendments or renegotiations. C covenants, importantly, were not significantly associated with amendments.
That really nails down the functional difference. P covenants trigger interventions.
It's the behavioral evidence backing the mechanism. And finally, H4, looking at negative covenants, those specific restrictions on dividends, capex, acquisitions, etc.
What did they find there?
Also confirmed the predicted pattern. Negative covenants were positively associated with P covenants, but negatively associated with C covenants.
Why is that combination important?
It reinforces the two distinct roles. If you have P covenants relying on ex post control transfer, adding specific ex post restrictions, negative covenants, makes sense. They complement that control mechanism.
But if you have C covenants,
if you have C covenants providing ex ante alignment through capital requirements, adding lots of extra micromanaging restrictions becomes somewhat redundant. The main alignment is already baked in.
so overall, the results seem to strongly support their core argument about two distinct mechanisms.
Without a doubt. They systematically tested the predictions flowing from the theory, and the data lined up across all four hypotheses. The research questions were definitely answered.
Which leads us to our final question, Q6. What conclusions do the authors ultimately draw, and are they warranted given the theory, design, and results?
Their main conclusion is that accounting information is used in debt contracts in these two fundamentally different ways, either to align interests up front via balance sheet constraints, C covenants, or to facilitate efficient state-contingent transfers of control via performance measures, P covenants.
And you'd say the conclusion is well supported.
I would, yes. The empirical evidence is consistent and robust across multiple tests. They don't just show association, they show patterns consistent with the specific theoretical mechanisms.
Is there any other evidence in the paper that really drives this home?
One powerful piece is the simple correlation they report between the presence of P and C covenants in the same contract. It's significantly negative, around men of 0.37.
Meaning they tend not to be used together.
Exactly. They act as substitutes, not complements. Firms choose between these mechanisms, which is precisely what you'd expect if they serve distinct functions with different costs and benefits.
Did they look at pricing grids too?
Yes, that was another clever test. Performance-based pricing grids, where the interest rate adjusts based on achieving certain performance targets, seem to substitute for rating-based grids when accounting contractibility is high.
Because the performance measure is a reliable signal in that case.
Right. But C covenants didn't show that same substitution effect with rating grids, again aligning with the idea that C covenants are less about tracking high-frequency performance signals and more about static, upfront capital adequacy.
It all ties together very neatly. So stepping back, this paper really solidifies how accounting information creates efficiency gains, connecting back to foundational ideas like Watts and Zimmerman, but through these two very specific structural paths.
Absolutely. It puts empirical meat on the bones of contract theory, showing how accounting mechanics fulfill these theoretical roles.
Okay, before we wrap up, let's share one last fascinating tidbit from the paper, looking at changes over time.
Ah, yes, the time series pattern around the financial crisis. Very interesting. They show that the use of C covenants, those strict capital requirement covenants, had actually been declining steadily for years, up until about 2007.
But then the crisis hit.
And immediately after, in 2008-2009, there was what they call a substantial reversal, a sharp, sudden increase in the use of C covenants.
What does that suggest?
It strongly suggests that when systemic risk spikes and trust evaporates, lenders immediately pivoted. They prioritized the hard guarantee of skin in the game via C covenants over the more flexible, but perhaps perceived as riskier, performance-based P covenants. A real flight to safety in contract design.
Fascinating reaction. Okay, let's leave our listeners with a provocative thought to chew on, building on this research.
Go for it.
We've seen convincing evidence that P and C covenants are substitutes, serving distinct economic functions. So here's the question for you to consider. If you come across a debt contract in practice that includes both strong P covenants and strong C covenants, what's really going on there?
Is it just a lender trying to cover all possible bases, a sort of belt and suspenders approach?
Or could it signal something deeper? Perhaps a fundamental lack of trust where the lender feels they need both the ex-ante capital lock-in and the ex-post performance tripwire to feel secure. What does that combination truly reveal about the perceived risk or the relationship?
Something to definitely mull over as you encounter these structures in the real world.
Indeed. Thank you for joining us for this deep dive.
Always a pleasure.
See you next time.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.